Hello and welcome to Quarterly Perspectives, third quarter 2018. My name is Jonathan Scheid and I serve as the Vice President of Portfolio Strategy and Education at Loring Ward, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset class performance, and the second part looks at recent market and economic headlines. We start our performance discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S. stocks performed the best of the group during the quarter. International stocks gained slightly, and emerging markets struggled. For bonds, interest rates rose, resulting in mixed performance. In reviewing the U.S. and international size and style segments, we can see a few trends. In the U.S., large stocks outpaced small stocks in every style category. In developed international markets, value performed better than growth in the mid and small cap space. When we look back over the last 15 years, we see that small stocks outpaced large stocks in the U.S. in the value and core category. And that tilt towards small company stocks versus large company stocks has rewarded investors with a 15-year annual premium of 0.3% on average. From a style perspective, value stocks underperformed growth stocks, with a 15-year annual difference of -1% nationally. Investors tilted towards small companies experienced a 2.8% annual advantage over large stocks, while value companies suffered a -0.1% disadvantage versus growth stocks. This is an important reminder that the premiums we expect to receive from value companies and small companies are not guaranteed. In fact, this is why we feel it is wise to have multiple factors of return in our portfolios at all times. When we look at the year-to-date asset class returns on this chart, we see asset classes in your portfolio ranging from a positive 11.5% for U.S. small capitalization companies on the high end to a negative 4.3% for emerging market values on the low end. Maintaining a diversified asset mix, such as a 65% stock, 35% bond mix shown in white, kept you away from the more extreme returns from year to year with significantly less volatility over the past 15 years. This highlights the importance of maintaining a well-diversified mix of asset classes in your portfolio. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. The overall return on this index mix for the third quarter was 2.55%. All but the international small asset class added to the overall return of the portfolio during the quarter. This chart highlights the benefit of owning multiple asset classes in your portfolio. Let's now turn our attention to some of the major stories we saw in the most recent quarter. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that may tempt us to make investment decisions we may regret. It is wise to stay informed, but we feel it is very important to keep a long-term perspective when it comes to investing. As we can see from some of these quotes, Apple became the first trillion-dollar publicly traded company, and the S&P 500 reached an all-time high during the quarter. Let's look at some of these milestones and their implications a little more closely. And we'll also address some of the market volatility that greeted investors after the quarter end. During the third quarter, Apple became the first publicly traded company to reach $1 trillion. It took them almost 38 years to grow from their IPO value of about $1 billion to today's value of $1 trillion. Innovation and hot products drove a lot of their success, but investors looking to profit off of Apple now, or those in search of the next Apple, need to remember that there are never sure things when it comes to investing. To elaborate on this point, we prepared a simple chart that compares some of the downside volatility that Apple experienced in the 38 years as a publicly traded company. Investors in Apple stock had to experience 2 declines greater than 60%, 1 decline greater than 70%, and 2 separate declines greater than 80%. Investors in the S&P 500, a more diversified investment, didn't have to. In fact, there were only 12 declines greater than 10% for the S&P 500, but there were 32 declines greater than 10% for Apple over the same time period. While we may be impressed by the tremendous upside the company experienced to date, it is also important to remember the total picture when evaluating any investment or investment strategy. It seems to make sense that when Apple, which is one of the largest holdings of the S&P 500, is reaching a milestone, that the overall index may be reaching its own milestone. And that was the case in the third quarter when we saw the S&P 500 close at a new all-time high. All-time highs may make some investors concerned since there's a fear that this is as good as it gets. But that historically hasn't been the case. In fact, higher markets tend to follow market highs. The bar chart helps make this point as we see a higher percentage of positive stock market results following month-end market highs than we do versus all months. And as we would expect, as time passes, the difference wears off. The table on the right looks at the total returns following market highs versus every rolling month-end period. And here we can see total returns are greater following market highs than every month. And just as we saw in the percentage of returns being positive even out over time, we can see returns even out with the benefit of time as well. While the US stock market may have reached a recent all-time high, the same isn't true around the world. Here we can see that only Sweden reached a new all-time high when looking at month-end index values. All other nations are still below previous all-time highs. This surely speaks to the benefit of international diversification. While we addressed the concern about all-time highs on the prior slide, investors should take comfort in knowing that they are invested in a wide range of countries that are in different phases of economic growth and at varying market levels. And the same is true for emerging markets. None of the 24 emerging markets part of the MSCI Emerging Markets Index are at an all-time high as of the end of September 2018. So it makes sense that local emerging markets provide diversification to US markets that are at all-time highs. And finally, as we were preparing these slides, we noticed stock market volatility pick up after the quarter end. While some people will be quick to say that market highs caused the volatility or that this volatility was inevitable given the recent gains, the reality is that stock markets have always been volatile. In fact, it is that volatility, that is, the lack of a guaranteed repayment of principal or an assured gain, that has made stock market returns historically so rewarding. Every year there are ups and there are downs in stock market value. The gray bars on the graph show the size of the inter-year gains and the inter-year declines. From 1990 to 2017, the average inter-year decline was a negative 13.4%, and the median decline was a negative 10.1%. Surely there are years where it doesn't decline as much, and there are years where it declines a substantial amount more. But the two important takeaways from this chart are number one, that volatility happens every year. And number two, that despite that volatility, markets tend to end up positive. As we can see, over this time period, the market ended the year with a decline in only 5 of the 28 years. That means that 23 of the 28 years, or 82% of the time, the market closed the year higher than it began, even after experiencing double-digit declines in many cases. This concludes our presentation for today. Thank you for joining me. To review this and past commentary, please see Loring Ward's YouTube channel. Thank you.